Imagine waking up to a stock market meltdown. Here is how to protect your investments and even take advantage of opportunities to make your net worth explode. Right now, we've got several signs of an impending stock market crash. To start with, auto loan delinquencies have hit a 13-year high. What that means is people can't make their auto loan payments. It means that eventually these cars are going to get repoed, that people aren't going to have vehicles, that they can't go to their jobs. The last time people were this bad at paying their auto loans off was in 2010, right after the Great Recession. And part of the reason for that could just be inflation has been completely ridiculous lately. Look at this chart of the increase in car prices lately. From 2019 to 2023, it's gone up 50%. The same car that might have been $40,000 back then could be $60,000 now. Plus the price of everything else in life, your eggs, your bacon, everything has gotten so much more expensive that it's nearly impossible for everyone to stay on top of their financial obligations. Speaking of that, credit card delinquencies have hit a near 12-year high. And this is probably even worse because the standard credit card interest rate is double or triple that of a standard auto loan, which means people's finances are getting absolutely hammered right now. The last time credit card payments were this overdue for this long, it was again right after the Great Recession. And to make that all worse, credit card interest rates are at record highs. So all those balances that are going unpaid right now are just melting down everyone's net worth. What's the average rate? 22.8%. I would jump for joy if I got 22.8% in return whenever I'm investing in the stock market every year. That would make me a very rich man very quickly, but that's going in the opposite direction for us. That means it's draining our accounts at that rate. Plus, your actual balance isn't getting paid off. And all of this comes together to form some pretty negative indicators. And that's why people like this guy, Mark Spitznagel, are predicting a giant bubble event. He calls our macroeconomic situation right now a mega tinderbox time bomb. And this guy runs a hedge fund that basically bets on things going wrong. He's made over $1 billion in a single day by using that exact strategy, and it's worked out for him. In normal times, whenever the stock market is doing well, he's not doing well because he's betting on things going down in the toilet. But whenever they go south, he goes really far up. He makes crazy amounts of money based on things going wrong. And so it makes sense that he would be negative and he would think that something like this is going to happen, but he also doesn't think it's going to happen like right away. That right now, as the Fed can potentially ease rates, we're going to be in this little Goldilocks phase. So inflation's going down, rates are going down, things are turning around for the stock market, and we're going to have a rally here for a little while before this ultimate crash. In part, he's calling this the greatest bubble in human history because of public indebtedness, because of all those things I just talked about where we're being delinquent on our loans. And this can't just perpetuate for forever. And you can't just have a mass amount of people who owe all this money and not have an impact overall on our overall economic situation. He's also claiming that something like a government bailout is a lot harder to do now than it used to be. And so the impact of a big recession is going to be deeper and harder felt than it was in the past. And speaking of the government, his justification for why this is happening is also government-led. He said that they've been working so hard, the government that is, has been working so hard to mitigate any of the problems that we've had with the economy, to try and keep the stock market going, to try and basically prop up all of these things that maybe should have been allowed to fail earlier. They've exacerbated the situation and they've created a bigger fall that's about to happen. So if all this is true, and if the stock market is coming up to an impending cliff, if we're about to experience a 30 to 50% loss in the value of our investments, what do we do about it? How can we set ourselves up now to profit? Well, before I share with you my opinions on what we can do in terms of our loans, the housing market, and the stock market itself, I'll share with you what Spitznagel says. He's got some advice for the everyday person. A lot of his advice is to basically do nothing, to stay invested. It almost sounds like the opposite advice of what I expected him to say. I thought he would say, sell everything, put all of your money into our fund, like count on this happening because he's predicting it. But apparently for the average person, he thinks just holding fast is basically the way to go. Hey, if you're new here, I'm Brendan and I make new personal finance and investing videos for you every single weekday here on YouTube, totally for free, almost every weekday. Sometimes I don't make it. But my wife and I became millionaires last year at 37 years old. And my goal here, the purpose of why I'm doing this is to help people to grow their net worth and your financial security, and to do that wisely and sustainably. So now I'm going to talk about what options we have when 3 different massive changes happen. A, when the stock market crashes. B, when interest rates drop. And C, when the real estate market shifts. In my personal opinion, which is not financial advice, for all those scenarios, I think that having cash on hand and ready to deploy gives you amazing options. To have a bunch of cash on hand and have it sitting there stagnant, doing basically nothing right now, but earning a decent yield in like a high yield savings account, doing that isn't the most efficient return for like the long term. I don't think it makes sense to do for 10 or 20 or 30 years, but being that person with a massive variety of ways to take advantage of troubled times is really, really powerful. So how do we do that? How do we get cash on hand ready to deploy? Well, I think there's kind of two different options. You could sell your investments and sit on cash, but that will likely be bad timing because we all suck at timing the market. Like Spitznagel says in the article, Cassandras make terrible investors. Brendans make terrible investors. We are not good at timing the market. And so the likely thing that would happen is we'd take all this money out because we're thinking a crash is going to happen. We'll have a big fat tax bill on it because we've gotten gains over the years. So we've got to pay taxes on it. We're sitting here on cash, and then the stock market would probably just keep going up. And so it wouldn't be a great option for us to do that. But even if it goes down, that makes it tricky for us too, to time it exactly. How do you take your money out right before the crash happens, but not missing out on a bunch of growth for the next 6 months, year? Who knows how long it could go up before a recession hits. Option 2 to free up some cash is you could just stop investing for a time and take the cash that you had been investing or had been spending on other discretionary things, stick that money in a high yield savings account, in a cash sweep account with your brokerage, put the money in CD ladders, whatever it takes, and use that as a method to prepare. In my opinion, this is likely a safer bet than option number 1 was, and it still allows you to have some liquidity, have some money ready to deploy whenever you need to, whenever things go south. So once you have the cash, once things go south, what do? Let's talk about the stock market first. Number 1, it will go down. Sooner or later, prices will drop, our principal value will drop, and so we can just expect that to happen. It's bound to happen over time. The problem is, if we see that happening and we panic and we sell out of our investments and we say, I'm taking my money out, it's dropping too much, I'm too afraid of this, then we're locking in that loss. We're making sure that we're not there to be able to recover if and when the stock market recovers. If we don't cash out of our investments, we stand a chance of retaining that value, whatever principal value is left, which could still be more than our original cost basis. Depending on when you started investing, you could still be technically profitable, just down from your previous high. And then over time, as the market recovers, we're right there ready to soak up all of that recovery. But if we're talking about ways that you can grow your net worth whenever the stock market has crashed or has had some kind of notable, big, fat, nasty recession, if we're not going to be able to take advantage of Universa, which is Mark Spitznagel's doomsday fund, essentially, then I think the next best option for us to grow our net worth in a stock market recession could be to buy more. If you've stopped your investing because you're expecting a crash, you've got some cash piled up, you cut off your discretionary spending, and so you put together a pile of money. Let's say you've got $10,000. Well, after the stock market's gone down 40%, throwing that 10 grand in there could be a great way to ride that wave on out of the recession and profit as much as possible. I've talked to some people whose strategy is to do basically exactly that. They've got the cash sitting there ready to go because they're expecting the stocks that they like to be on sale in the near future. It's kind of like waiting for a sale. Now, I don't have a crystal ball, so I can't say exactly when that sale will be, but the potential is there. Now let's talk about what happens if interest rates do drop, because it's all over the news that at some point this year, the Fed is likely to lower rates. If the Fed lowers the federal funds rate, that means that the cost of borrowing for us, for most other things in life, has just gotten cheaper. When people see that on the horizon, like this week, if Jerome Powell says, hey, we're going to lower the rate in September, that means everyone's going to get excited, and the potential is that stocks could rise. We're anticipating all these businesses that are in the stock market to now have cheaper cost of capital. Now they can grow, now they can expand, now they can spend some money and actually have a good return on it because their interest rates aren't so high. So if you had that cash sitting somewhere like a high yield savings account or a brokerage cash sweep program that's making 5% interest, that's good. But then if your interest rate suddenly drops to 2%, that's not as appealing to keep your cash sitting around. The 5% is a great time to have cash right now. Like it's an amazing little period in life. And I've gotten comments on things like my dividend investing videos that say, oh boy, you've gotten a 5% return. You could have just slapped that in a high yield savings account and gotten the same return. Who cares? Well, the reality is our savings account are not going to be getting 5% for much longer. That's my expectation. That's my guess. But over the course of time, 5% is not the norm for savings accounts. So if this reverts back to the norm and we're at 1-2% again, cash is not that appealing to hold on to. So if rates are going to drop, that means your cash is now sucky. That means the interest rate's now appealing. I think for a lot of people, stocks are going to be more appealing. And the natural move then could be to slam that cash into stocks, ETFs, index funds, burritos, race cars, all your favorite things in life, and watch those things just grow in value. The burrito only grows in value when it's in your mouth, but everything else grows in value potentially objectively. Now, what about real estate? What happens if these kinds of confluence of events happen? What if mortgage rates drop along with the other rates due to the changes the Fed is going to make? Right now, if you've already got a mortgage, I think the thing that makes the most sense is potentially look into a refinance. My wife and I locked in a pretty cheap interest rate whenever we bought this house in 2016, but then the rates dropped after that. It was a crazy, crazy time with historically low rates. And so we went, hey, does anybody want to refinance for us? And our mortgage broker said, no, you don't have enough of a loan for it to be worth my while to refinance. But our actual mortgage lender, who originally did the deal with us, sent us a mailer I got a postcard in the mail that said, hey, we would refinance for you. And I thought, is this specific enough, or did they just send this out to everybody? Turns out they did know. And so we did refinance. We got a lower rate. We saved a little bit of money, and we knocked a mortgage term from 15 years down to 10 years with a crazy low rate. Now, was that a perfect decision in hindsight? Who knows? I'll link a video for you to watch at the end of this video where I kind of go over all the different options we could have had there. Maybe with a lower rate, we should have locked in a longer term and had a tiny little payment. We could have had more money to invest in the meantime. There's some potential regrets with how we structured our own mortgage. But if you're going from a 6 or a 7 or an 8% mortgage because you just got a house in the last couple of years and now rates are down to 4%, then it could really make sense for you to refinance. If you do decide to refinance, you've got a few options. Number one, you could keep or renew your same term. So for a lot of us, that's a 30-year term. If you keep the same term, but you lower your interest rate, the natural consequence of that is probably going to be that you lower your payment as well. So if you've got a lower payment, that leaves you with a chunk of money that you were otherwise spending on your house before, and now you can use that money to save, to invest, to pay off other debt. Whatever strategy you want to use to grow your net worth the fastest now is freed up because you've got that chunk of money. Another option you have whenever you refinance is you could do like we did, and you could shorten your term, lower your rate, and then you have about the same payment. So you don't have a lot of cash month to month that's any different. Like if anything, it was exactly the same for us, but you could save yourself a metric crap ton of money over the course of the loan because you're paying off the loan faster and cheaper. So it kind of depends on your perspective. If you want to free up money now, you could keep your term but lower your payment. If you want to pay less money over the course of your lifespan, then you could have a shorter term and about the same size payment. But because it's a cheaper rate, you save money. But also, if you haven't bought a house yet, and all of a sudden mortgage rates go from 7% down to 4%, then all of a sudden that could be a real reality for you because that mortgage payment that you've got to live with has just gotten tremendously cheaper. Houses have been unaffordable so much for like the last 2 years. And so now all of a sudden a drop in rates can make owning a house a real possibility. The only tricky thing about that for you could be that then everyone thinks that same way. And they all go, well, I couldn't afford that $400,000 house before because the payment was $2,900 a month. But now if the interest rate's only 4%, it's $2,000 a month. Now I can make that happen. Well, now the price of homes might go back up because demand has increased. The supply wouldn't have been significantly different, but if the demand increases because now mortgage rates are cheaper, everyone's monthly payment will be cheaper, then maybe the price of the house goes back up and the whole thing is equalized anyway and we're screwed again. So that may happen, but it's difficult to predict exactly how it's going to shake out. And it's so location dependent. You know, if you're in the middle of Kansas, that's very different than if you're in the middle of Manhattan or LA. Even amongst all those different options, I think there's a couple of things that are a very safe bet for us though. Number one, if you do have credit card debt, and if you are somewhere around that average of 22%, you know that paying that off is the safest bet to increase your net worth because you're essentially underground right now. You're below a positive number there. And so the faster you can get that paid off, it's basically the same overall effect to your net worth as if you were making 22% in terms of investments that you made. And this is not exactly a debt payoff video. And so there's different ways you can do that. I'm not going to get into them now. You can use something like velocity banking that people talk about. You can use something like the free $1,000 of margin you get from Robinhood. You can get one credit card that has an introductory rate of 0% and try and pay off another card because you're doing a balance transfer situation. And so it saves you money and interest. There's a lot of different strategies around doing that. I think the name of the game is however you're going to structure it, do it as quickly as you can. We've got to stop the bleeding before we really think about how to take advantage of something like the stock market. What's going to happen if the Fed does this? How do we benefit and how do we set ourselves up to grow our investments? I think if you've got credit card debt, then investing needs to be a secondary discussion after you pay that off first. But what would you do if the Fed did lower rates? That means the stock market's probably more attractive. It means buying stuff is probably more attractive. It gives you all kinds of options in terms of what you can do with your house and your mortgage. And for us, here's what we did in response to that. But do you agree or disagree? I go into all the details of what our thought process was, but I think a lot of people out there would disagree with us. And in hindsight, I even disagree with us because we could have made more money doing other things. I would have done this differently in hindsight, but in the moment, you only know what you know. So check out that video next and let me know what your opinions are on the decisions that we made. Thank you so much for channel members for your support directly. And everyone else, I'll see you tomorrow. Bye.